All right, good evening, everybody. I hope everybody's well. Hope you survived the snowstorm. I got to tell you, up here in Newmarket, we had no snow, so um, I survived it very well. I apologize. I'm coming down with a cold, so my voice is kind of weird. Nothing I can do with it, so I guess we have to deal with it. Alrighty. I've had questions about seeing marks, and everything that was done in Connect, you should be able to see the marks too. Um, the if you can't, the lowest mark on the first quiz was 70. The lowest mark on the midterm was 73. The average of the first quiz was probably 90, and the average of the midterm was in the high 80s. So I don't think anybody needs to be seriously concerned about failing at this point. Um, Everybody should be able to see the marks from what they submitted last week. They're all marked and back in Blackboard. I believe that there was one mark that was adjusted because of lateness that puts it into about the 75% territory. Everything else is above 80. So everybody should be relatively fine with marks right now. Um, the final exam is coming up next week. It is comprehensive for the year. I will put something out Saturday or Sunday that gives a detailed breakdown of what I'm looking for in the exam in terms of timing, how many questions and stuff like that. And if there's any questions after that, please reach out to me. The exam is online. It is asynchronous. It will be open from midnight till midnight on the 5th. You will have 2 hours to complete the exam. Once you start it, you cannot go out or in. So once you start it, you got to go because the clock keeps ticking whether you close it or not. So a couple of things to remember. I'll write all this stuff down, don't worry. So today we're on the last chapter, chapter 12. We've been looking at ways to value companies and value stocks, and we've come up with just a ton of different ways. And that really reflects what's going on in the market. There are a bunch of different ways that we can get to the same answer from taking different passages or different paths to get there. We're all going to end up with the same answer ish, and that is what is this stock or what is this company worth? And that's what we're looking for. Today, we're going to take a different look at things. And I hope by now we fully appreciate that if we are willing to take a risk, we are willing to expect a return. To flip that on the side, the higher return you expect, by now you should be willing to know that, or you should be know that you have to be willing to take some risk to get it. What we've been doing in the last couple of exercises is trying to quantify what that means. What's it mean to take risk? Once we get a feel for what risk is, how do we measure it? And if we're measuring it, is there a way to chart the expected risk that we take against the return that we should anticipate getting? And yes, there is. And we've been doing that for the last few weeks. And then last week, we talked about the capital markets pricing model, CAPM, uh, pricing model, whatever, the pricing model. And what that did is it said, you know something, our return is a combination of a bunch of things. Specifically, our return is what we expect to return from the stock and unexpected components as well. Those unexpected components can be broken down. Of those unexpected components, some of them impact everybody equally. If there is a surprise economic release, it's going to impact everybody the same. That's called a symptomatic unexpected result. Some unexpected results are only you, are only the stock that you're looking at. I don't know, if we're looking at a miner, it could be a catastrophic flood where the mine is or something like that. It's not going to impact any other stock except yours. That's an unsystematic, unexpected. And the two are the ones we have to look at. What it turns out with that we learned last week is as we diversify portfolios and add more and more and more stuff into the portfolios, um, the unexpected, unsystematic risk, so the risk that's unique to each stock balances out as you start to get a bigger and bigger portfolio. We can get rid of most of it by about 100 stocks. And at that point, if you have a plus on one stock and a minus on another stock, those all kind of even out after a while. And when you get a big enough portfolio, the diversification tends to nullify those um, unsystematic, unexpected shocks. So all we're left with then is the systematic ones. So if we have a big enough portfolio, the unsystematic shocks kind of go away. And then we're left with the systematic shocks that we have to hedge. And that's what's going to happen to our entire portfolio if interest rates go up, if the GDP is low, if the president, please, gets assassinated. I didn't say that. But this is the sort of thing that we have to consider now. We're putting together a portfolio. We're trying to figure out how do we get the best return out of our portfolio given the risk we're willing to take. And then what are the unexpected hits that we have to kind of figure our way through? So chapter 12 takes a different approach to that today. We will have our land acknowledgement. We are on borrowed land. It's located land stewarded by the Anishinaabe, Haudenosaunee, and Wendat nations. We acknowledge Treaty 13, et cetera, et cetera. My family actually very specifically is attached to the land acknowledgement because when we immigrated to Canada, we immigrated in the 1800 area, so 1795 through 1820 or so. Most of us came to the London, Ontario sort of area. Um, at that point, we were farmers. We accumulated quite a bit of farmland, and we bought it from the government, or we bought it from the people that were selling bits of Treaty 13 purchase or others. Um, and we assumed we were buying it in the correct fashion. The problem is the people that were selling us the land didn't have the right to sell it. They'd taken the land from indigenous people, and those indigenous people wanted it back. So, sometime in the mid 1800s, there was a reconciliation period where a lot of farmers were approached to say, you know something, we got to give some of this land back. My family lost a bunch of farms near the London, Ontario area that were put together to make the first of the Seneca um, First Nations. Uh, and that's what happens when your brain goes dead, ladies and gentlemen. Um, Reserves, sorry. Um, that reserve is still in existence. It has to be one of the more profitable reserves, and they're doing very, very well then. However, uh, that just it tells you that this is something that's ongoing. It's something that we've been dealing with for um, generations, and we will have to continue to deal with for generations. And just a fruit of thought. When we talk about random things like Alberta separating or BC separating, they can't. And the very good reason they can't is that the bulk of the land in Alberta is treaty land. It's not owned by the people of Alberta, it's owned by First Nations. The bulk of the land in BC is treaty land. It's not owned by the people of BC, it's owned by First Nations, so they can't separate. That's something to think about. Anyway, I digress. We're going to talk about alternative views of risk and return. Specifically, I mentioned the unsystematic risk. That's problematic, but we can kind of get rid of that when we diversify our portfolio. So now we got to look at how we get rid of the systematic risk and the impact of betas on that. And then we're going to look at a couple of portfolio models and factor models that help us price. Finally, we'll look at betas, arbitrage, and expected returns. We're going to look at the capital asset pricing model and the arbitrage pricing theory, and then some empirical approaches. This gets us to essentially where, as a financial analyst, you start to understand how portfolios are put together and why we put them together and what we're looking for. So, arbitrage pricing theory. Questions for you. Earnings that came out in 2023 and 24. Alphabet was expected to pay an anti-competition fine in 2023 of $700 million. Once they paid that fine, the stock went up 2.5%. Pay a fine, stock goes up. Tesla was expected to show results of $22.2 billion and our earnings per share of around 50 cents. Came in at 21.3 and earnings per share of around 45 cents. What was the result? Tesla stock went up 14%. AutoZone, all of their results trashed expectations. They were fantastic results. Net result, their stock fell 3.6%. How do we get these equity moves that run counter to expectations? And the problem is expectations start to become reality. And we're no longer trading the actual news that comes out. What we're doing is we're trading the actual news versus what was expected. Because we can hedge what we expect. And then if something unexpected happens, that's what the hedge is for. The problem is we have to always figure out what's actually expected versus what's actual. Anyway, that's where we're at. Later on, we're going to talk about convergence. And at that time, I want you to come back to remember this story. Long-term capital management. It was a hedge fund that was very large in the late 1990s. Basically, it was the first of the macro massive hedge funds. It traded a core investment strategy known as convergence trading. That's theoretically, if I have something that is overpriced versus something else, I sell that, I buy the item that's underpriced, and when they converge, that's my profit. And it worked out pretty well. They returned 21%, 43%, 41% in their first 3 years. And then in a matter of 4 months in 1998, they collapsed and went bankrupt. They lost $3.6 billion. Well, they didn't lose anything. $3.6 billion were lost and 14 banks took the loss. And the problem is their model was broken. Until it was properly stress tested with billions of dollars, they had no way of, well, they had no realistic way of knowing how it was going to fail. And when it failed, it was pretty spectacular. Thankfully, that was when I, as a salesperson, was just trying to sell them on our services, and I never really got in the door just before they went bankrupt. So, swing and a miss on that one. So, introduction. We looked at the capital asset pricing model a few times. It shows that if a market portfolio is mean variant efficient, that means as long as we're looking at a portfolio that has a normal distribution, the variants fall within what we expect to see. The covariance and coefficients work very well together. And as long as that holds, then the expected return is supposed to be linear related to beta. Said before that our diversification, as we've seen it, eliminates unsystematic risk. So what we're left with then is systematic risk. But let's take a step backwards and make sure we're all caught up here. What's the beta tell us? The beta tells us the response of a securities stock to systematic risk. Once again, systematic risk is the risk that impacts everybody the same. Well, I wouldn't say the same, but impacts everybody at once. Economic releases, earthquakes, stuff like that. That's the stuff you cannot get rid of with diversification, because anything that's systematic is going to move the whole market. The S&P 500 is going to squirt higher if we have a GDP number that's way higher than expected. What's going to happen when the S&P pushes higher? Every stock in the S&P is going to be dragged higher. That's a systematic risk because it impacts everybody at the same time. So when we looked at the return on a stock, what we looked at was this is the expected return on the stock, but sometimes the stock doesn't happen that way. So we also have an unexpected component. So the return combines expected and unexpected pieces. Um, the unexpected returns are both systematic and unsystematic. Unsystematic risks are related, but they're related but offsetting. So within a portfolio, the ups are going to cancel out the downs, and the impact pretty much goes away. The systematic risk is what's left. That's the beta coefficient. So, and there'll be a beta coefficient to every systematic risk. However many you want to put into the model, we will have a beta coefficient. So if we're looking at GDP and then we're looking at, I don't know, unemployment, we're looking at other stuff, each one will have a beta component. Um, for example, um, stocks of a firm owning gold mines have a positive inflation beta. If inflation goes up, gold goes up. That's what the positive inflation beta means. A broker who buys one market and sells another is probably unaffected by it because the stock that um, goes up the way it should, and the stock that goes down the way it should. Their price is going to incorporate these moves. They're going to have a zero beta. They're not going to, the whole portfolio is not going to move because the individual stocks are going to cross themselves out. That's a zero beta. Some companies with very tight margins and a lot of foreign competition may be negatively impacted by inflation. So rather than saying, hey, we're squirting higher, in this case, we're actually going to fall. In that case, it's called a negative inflation beta. So we can have different betas for different things, but each security in each portfolio is going to have a beta to whatever we're looking at. So if we're looking at inflation, each stock will have an inflation beta and the portfolio will have an inflation beta, etc. So say we have three risks we want to focus on. Um, in large portfolio analysis and large um, uh, uh, fundamental models, sorry, I've got a friend who runs a hedge fund in Toronto. Um, he runs multi-factor models on that hedge fund, and he probably has 20 factors involved. So for each stock, he has to do a 20-factor matrix. It's nasty, but it's possible. So in our case, we're going to look at three because we think three is probably enough to do what we have to do. We're going to say our stocks, the return thereon, are impacted by inflation, GMP, and interest rates. You will hear me flip back and forth between GNP and GDP. They're not quite the same thing, but they're close enough for me right now because I'm not teaching you economics. So if I say GNP or GDP, it's the same thing for me right now. So we know that the return on our portfolio or our stocks is going to be the expected return plus the unexpected component. The unexpected component is going to be comprised of symptomatic and symptomatic? No, systematic and unsystematic components. So we have the expected return, which is ER. The systematic components are, well, it's not supposed to be M, but that's all I got. And the unsystematic components are the E. If we break this up a little bit more, we end up with um, the expected result plus the systematic beta of inflation plus the systematic beta of GMP plus the systematic beta of interest rates plus the unsystematic component. So assume in a year, inflation's 5%, GMP's 2%, and interest rates are unchanged. Where is this? Here. Okay. Our stock has a beta to inflation of 2, a beta to GMP of 1, and a beta to rates of minus 1.8. Now, what do the numbers mean? Well, 1 is a perfect correlation, minus 1 is a perfect negative correlation, 0 is perfectly no correlation. We can have bits of anywhere between them. If we have a number more than 1, then we have a more than natural reaction to whatever is whatever we're looking at. For example, if GNP is up by 2% and we had a beta of 2, then we would expect a 4% move. All right. So moving down, we have the three risks we're focusing on. Where did I get all this? Ah, here we are. Excuse me. The unexpected news for our stock is out. So in this case, our unsystematic piece for our stock is 5%. What are we going to look at then? Anytime we have expected and actual results, we have to look at what the difference is between the two. So for inflation, we're expecting 5%. The actual came in at 7%. The difference is 2%. Same with GDP, same with rates. So what do we have? The systematic portion of the risk is our beta, which was 2 for inflation, times the 2% difference, the difference between expected and actual. The systematic portion for GDP is the beta for GDP, which is 1, times the expected minus the actual, which is minus 1. Sorry, actual minus the expected, which is minus 1. And then finally, we have the systematic portion for interest rates, and we had a negative beta. We had a minus 1.8 beta, and the difference between what the actual was minus 2, we're expecting 0, so the difference is minus 2. So our equation then is going to be 2 times 2% plus 1 times minus 1 plus 1.8 times minus 2, which is 6.6%. Remember our unsystematic piece is 5%. So the combination of 6.6% systematic and 5% unsystematic gives us 11.6% unexpected move. The expected return for the stock was 4%. Our unexpected return for the stock is 11.6%. The total return is 15.6%. This is the factor model for systematic risk. We're going to explore it a little bit more in a second, but it's not what we're trying to come up with, I guess, is a weighted beta factor. How much of the unexpected move in inflation are we absorbing? How much of the unexpected move in GNP are we absorbing? How much of the unexpected move in interest rates are we absorbing? And how are we absorbing them? In what direction? Well, we have a 2% surprise move in inflation. Our beta is 2. So that's equivalent to a 4% move. We have a minus 1% move in GDP. Our beta is 1, so that's equivalent to a minus 1% move. So far we've got 4% minus 1%, which is 3%. And then our minus 2% difference in rates has a beta of minus 1.8, so it's going to have a positive, minus times a minus, is going to have a positive impact of 3.6%. So we had 3% plus 3.6%, 6.6%. If you can get the concept, what we're trying to get here, don't let yourself get confused by the um, formula. It's relatively simple what we're looking at here. And I'll break it down in a minute, but it's relatively simple because what we're looking at here is for any return, we have an unexpected component and we have an expected component, sorry, and an unexpected component. The unexpected components can be comprised of systematic pieces that impact everybody and unsystematic pieces that impact only you. When we set up different factors, we put up factors in place for the systematic pieces. What are the three things we think is going to move the entire market? Well, inflation, GMP, and interest rates. Okay. Um, it's not the number itself, though. It's how far that number is from what we expected it to be. So in our case, we expected to have 5% inflation. We actually got 7%. 7% minus 5% gives us a 2% differential. So we're going to look at the impact this 2% differential has on our stocks or on our portfolio. You don't have to look right at the top of my head. Sorry about that. For GDP, we're expecting 2%. We actually got 1%. 1% is 1% smaller than 2%, so it's minus 1%. And for rates, we're expecting nothing and they actually fell 2%, so it's minus 2%. Those are our three factors that are impacting our portfolio or our stock. But we know specifically how each one of those factors will impact it. And specifically, the beta for inflation for this stock is 2. So whatever the unexpected difference is, 2 times is what's going to impact this stock. For GMP, the beta is 1. So whatever the unexpected difference is, times 1 is going to impact the stock, etc. for as we go through it. And that's the factor model. So don't let yourself get confused. Don't let yourself get spun out here. The formulas are going to look big and they're going to look complicated, but break them down into pieces. And when you break them down to pieces, you can understand what we're trying to figure out here. So the factor model we can expand, and we'll say expand it into the K factor model. And the K factor model says that for K factors, and K being a number in this case, the return is the expected return plus each factor times the beta plus the unexpected return. The unexpected return, the unsystematic return, sorry, the unsystematic return is specific to each stock. They're not correlated to any other stocks. It's specific to just that stock. Um, so they will tend to have different numbers and different directions. And as I said, as we diversify, we tend to get rid of that piece. We get rid of the unsystematic piece because they tend to nullify each other out. Now, we can add as many factors as we want. It becomes more complicated, but it's possible. We have computers. They can do things for us, right? We don't have to do the calculation ourselves because we have this computer slave that does stuff for us. We don't have to do it. However, when economists and researchers talk about what's happening in the markets, they're not going to talk about what happens over 3 or 4 or 5 or 6 different factors. They're going to stick to one. How does the market move if inflation is better than expected? How does the market move if interest rates are different than expected? How does the market move if you get the point? They also normally don't use individual stocks. Because I can do all the analysis on the world and I can publish it and I can have a great following and people love me and they expect me. But if you don't have the stock I happen to do the analysis on, it's worthless. So normally, rather than doing stocks, they're going to use indexes because the index incorporates a bunch of stocks. And if we're talking about systematic impacts and we pick an index that is moved systematically, then it starts to make a bit more sense. For example, if we're looking at the S&P 500, and we're looking at the beta for interest rates. If the S&P 500 reacts positively to that, the entire index moves up. Every stock in the index is dragged higher. It's where the expression "a rising tide lifts all ships" comes from. Everything moves up. That's why it's called systematic, because if it impacts everybody at the same time, we don't have to look at everybody across the board. We can just say everybody's going to be impacted at the same time, to the same degree now. And we know that. But if the index itself is dragged higher, then everything in the index is dragged higher too. So when we look at something like the S&P, we would say the return is the expected return plus the beta of the return on the S&P minus the expected return on the S&P. There's also only one subscript. There's only one factor here, so we don't have to put all this into subscript. But it remains the same. It's the expected component. Sorry, it's the expected component and the unexpected component. And the unexpected component is broken into the unsystematic piece and the systematic piece. Um, All right. Any questions so far? Okay. What happens to a portfolio of stocks when we look at the one factor model? Say we create a portfolio of N stocks. I don't know, make N whatever you want to make. I wouldn't go over 100 because we know that it starts to decline after that, but anywhere in there is just pick stock I. The return for stock I, RI, is equal to the expected return for RI plus the beta for I times the systematic piece plus the unsystematic piece. Um, F here, we're not going to substitute with anything because it impacts all stocks, like GDP or whatever, right? If beta is negative, the impact will be negative for the index. If beta is positive, the impact will be positive for the index. If beta is 0, we don't expect the index to move at all. Specifically, each line in figure 12.1 here, the one factor model, is a different stock. Each stock has a different beta. Remember that the beta of each line is the slope of the line. So a beta of 1 should be a 45-degree angle. If we go up 5% in excess returns, we should have a 5% increase in the factor we're looking at. The factor in this case is probably GDP, but whatever. GNP, sorry. So if we have a 1 beta, means we have a perfect correlation. If we have a 5% increase, we're going to have a 5% increase. If we have a 1.5, we have a more than 1 beta. We're going to have a steeper line because we have a higher beta. So we're going to have more of a reaction in excess returns than we are in the return of the factor of GDP. So if GDP goes up by, say, 1% unexpected, and we have a 1.5 beta, we should expect our stock to go up by 1.5. And the same by 0.5. 0.5 means we're less than 1. We're going to have about half the slope. So if we have a 1% unexpected gain in GDP, we're going to have a 0.5% unexpected gain in our stock. Positive betas slope upwards from 0. Negative betas slope downwards from 0. 0 betas have no impact, so don't worry about it too much. Now let's talk, assume we're talking about GM stock, General Motors. An individual has $100 to invest in a portfolio. $20 of that portfolio will be in GM stock. 20 over 100 is 20%. So the the component or the um, weighting of General Motors in that portfolio is 20%. XGM equals 20%. Um, X1, 2, 3, and 4, etc., all the way up to XN are the different stocks in your portfolio. It's very important that we realize that all the components have got to add up to one. They all have to equal 100%. Um, uh, Once we accept that if we have 20% GM, so X1 is 20%, X2 is 30%, it's Tesla. I don't know, X3 is 10%, it's RBC because it's boring. We add all those up, and we're never going to have more than 100%. So that's rule one. Rule two is the return in the portfolio is a weighted average of each stock's return. So if GM goes up 10%, then 20% of that will be the increase in our portfolio. If Tesla goes up, I don't remember what it said for Tesla. So whatever I had 35% on, if it goes up 10%, 35% of that's going to be the increase in the portfolio. Um, so each stock has that, but each stock also has um, the factor impact, so the beta, and the unsystematic risk. Now, the good news is, as we create this portfolio, keep in the back of your mind that the unsystematic risk goes away. So then what we're left with is the weighted return on each stock plus the weighted impact of the factor on each stock. And that gets us to the way. That's why I said don't freak out about these, please, because we can create these as we go. The best, each one of our formula will be breaking down in terms of row 1, 2, and 3. And what are row 1, 2, and 3? Row 1 is the weighted average expected return. If I have, well, I just said it, if a GM's 20% and I get a return of 10%, 20% of that return is impacting the portfolio. We also have the weighted average of betas for the factor. Because GM is going to have one beta, Tesla's going to have another beta, RBC is going to have another beta. Some are positive, some are negative, whatever. But we're going to have to get those weighted averages as well. And then finally, the weighted average of unsystematic risks. So the weighted average of the unsystematic risk for GM, the weighted average for the unsystematic risk for Tesla, the weighted average for the unsystematic risk for RBC. And as we get big enough, those things all cancel it. But the uncertainty in our portfolio comes from the combination of the betas on the factor, so GDP, and the unsystematic risk. That's where the uncertainty comes from. So our portfolio return is going to be determined by exactly three factors. The expected return of the portfolio of the security. That's line 1 here, the weighted average of expected returns. The beta of each security multiplied by the factor. That's the weighted average of the betas. And the unsystematic risk for each security, which is the weighted average of the unsystematic risks. Or, I wonder where this is supposed to go. Well, it's supposed to be here. Hmm. So the return on the stock 1 is the expected return 1 plus beta 1 of the factor plus the unsystematic 1. And then we'll do the same for 2, we'll do the same for 3, etc. That's why single factor models are really, really cool. Um, But what's it telling us? What's what it's telling us is we go back to um, the pricing model from before the CAPM. This is the chart we came out of it. It says that as we add stocks to the chart, stocks to the portfolio, the unsystematic risk starts to go away. And the sweet spot seems to be around 100 stocks, but it can be different. After we've diversified away all of that unsystematic risk, we're left with the systematic risk. That's what we have to hedge. So how does this look? Let's assume that all securities have a return of 10%, the expected return. That just makes things easier. Let's assume that all securities have a beta of 1, because that just makes it easier too. So what do we end up with? The return on portfolio P on stock P is 10%, which is the expected return, plus 1 times the factor, whatever it is, plus however many stocks there are, 1 divided by that times the unsystematic risk of that stock, unsystematic risk of the second stock, of the third stock, of the fourth stock, all the way up to n. This starts to disappear. We've proven that a few times. Capital asset pricing model proves it 100%. We know that the unsystematic risk is going to go away. So that means that this entire piece of the row goes away. And all we're left with now is the expected return plus the beta on the factor. That's why we like portfolios. That's why we like diversification. Any questions? Cool, SA. Cool. Okay. Linear relationships. Recall that we know we have linear relationships. It's one of the key assumptions that we have. There's no efficiencies to accepting risk. You accept more risk, you accept more return. Right. The expected return on a security compensates for the risk coming at you. Nobody's going to give you a 5% return risk-free. It's not going to happen. The risk-free return is off government bonds, and it's not 5%. It's 1.5%, it's 2%, it's whatever. That's the return you can expect without taking a risk. If you want a higher return, you have to take a risk. We assume the market beta, standardized covariance of the securities return with those of the market, was the appropriate measure of risk before. Capital asset pricing model implied the expected return on the security is positively related to its beta, unless it's negative. The portfolio follows the same logic. All a portfolio is a combination of stocks. The logic that we can apply to the pricing of a stock, we can apply to the pricing of a portfolio if we add in the complications of each individual stock. Risk in a large, well-diversified portfolio is all symptomatic. We've removed and eliminated the unsystematic portion through diversification. So only systematic risk can be related to the expected return. We shouldn't be relating unsystematic risk anymore because we got rid of it in the portfolio. The only thing that's left is the expected result and the systematic risk. The systematic risk is the beta to each one of the factors that we inject into the model. So we have an expected return on the stock of 10%. We have GDP as our factor. We have a beta of 1.5 to GDP. That means that our expected return is 10% plus 1.5 times whatever the unexpected move in GDP is. So if we have an unexpected move GDP of 2, and the beta is 1.5, that means it's going to impact it 1.5 times 2 is 3. And we expected, what did I say? 10%. 10% plus 3%, we're going to get a 13% return. Don't make it more complicated than it is. Consider the line on the right. It starts at the risk-free rate of 10% and then grows accordingly as we go. We have betas of 1 and 2, and then we have expected returns. The risk-free rate, as I said, is 10%. It's going to remain there for the time being, so just risk-free rate's 10. Stock A has a beta of 50%. The risk-free rate is riskless, so it has no beta. That means the expected return is going to be 10%. I'm sorry. The expected return of A is 35%. The combination then is the riskless return of 10% plus 50% of 35% is going to give us 22.5% is the expected return of this portfolio. And that's a combination of our stock, which is 50% A, which has a beta of 2, and 50% riskless, which has a beta of 0. Boo, 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 boo. What we end up with at 225 or 22.5 is point P. And point P is the combination of 50% of A and 50% of the riskless. So now we have 3 spots and we draw our line. Investors are indifferent to small amounts of P and a combination of A. They're indifferent. It doesn't make any difference. Unsystematic risk of P can be diversified away in the portfolio. We know that. We can duplicate P with any security on the line. It doesn't matter. If we took L, which has, I don't say, beta of 3, figured out what the return was for 3, and we have, say, 50% of that and 50% of 10%, we're going to end up somewhere around halfway between C and A on this line. So we can replicate P any way we want with any combination of these stocks and our risk-free stocks. That's the capital asset pricing model, right? Now consider B. And we looked at this when we looked at efficient frontiers. Remember, we had our straight line, or if we have a large portfolio that looks more like a bat wing and we're trying to get to the leading edge of the bat wing, we have the same discussion here. Oh, and in that case, we're talking about risk on this side and return on this side. We said if we have 2 stocks that have the same return, sorry, we have return on this side and risk on this side. If we have 2 stocks that have the same risk, and one has a return of, say, 20%, and one has a return of 22.5%, for the same risk, why would you take stock B and not stock P? You never would. It doesn't make any sense. The same in a portfolio. We could accept B, but the efficient frontier of our security market line says don't. Because rather than accepting B, we can create P by taking any other security and combining it with a risk-free. So, the difference between P and B is something called arbitrage. And when I said at the beginning of the story this morning, remember long-term capital management. They had something called convergence trading. A true hedge fund is not supposed to have any directional risk. A true hedge fund. It's changed, the meaning has changed over time, but a true hedge fund is exactly what long-term capital was. We're just playing convergence. We're playing the arbitrage. Now hedge fund is becoming anything that's leveraged, so it's totally different now, but that's what it used to be. So in that case, we go back to here and say, If we have two stocks, P and B, that have exactly the same beta but different returns, one is probably undervalued and one is probably overvalued. So you want to sell the overvalued one and buy the undervalued one and wait for them to converge. Securities B is overpriced. We're expecting it to move higher. Securities P is properly priced. We're not expecting it to move. So if we sell B and buy P, they will converge together and we're going to capture at least some of that spread. That's what arbitrage is. And that's the arbitrage pricing theory. If we use the arbitrage pricing theory, we can start to apply it to other models as well. This allows us to create an equation using the for the security market line here, using only 2 points. We have the risk-free point, and then we have any other point. As long as we have any other point, we can create the straight line because we know it's linear. And then we can figure out when any other stock combination should be. So the risk-free over here, say it's bonds, and I don't know why they're at 10%, but they are. So risk-free is 10%, has a beta of 0. Point P has a beta of 1. So now we have the line. The return on security P is the expected return of security P. What do we do here? Oh, sorry. I should have put these all in lowers. Okay, so it's the expected return of any security on the market line is the return of that security plus the beta of the difference between my return and the risk-free return. So RF is the risk-free point, and our point is a P. So the expected return is the risk-free point, 10%, plus whatever our beta is to the factor, and the factor is the difference between our return and the risk-free return. That's the beta of security or of the portfolio. The beta is the slope of this line. What does capital asset pricing model say? The slope of that line, or the beta, measures the security's responsiveness to movements in the market portfolio. Arbitrage theory harps on that. It says the beta of a security measures the responsiveness to the factor, whatever the factor happens to be. So, what do we know? A large diversified portfolio has no unsystematic risk. It's diversified away. We know that. That means the market portfolio is perfectly correlated to the single factor. Implies the portfolio is just a scaled up version of different securities. The market portfolio lies somewhere on this line, somewhere on the security market line. When the market portfolio is the factor, the beta of the market portfolio is 1 by definition. So if we're comparing my portfolio against the market portfolio has a beta of 1. That's by definition. I don't know why I can't see it there, but that's what it is. So then the equation becomes the expected return is equal to the risk-free rate plus the beta of the expected market return minus the risk-free rate, where the expected market return is the expected return of the market. All right, so that gets us betas, arbitrage, and expected returns. We have 2 more pieces to cover tonight. Capital asset pricing model and arbitrage pricing theory. They're alternative models of risk and return. They both look at how we compare risk and return. How do they relate to each other? I mean, they're similar, but they're not quite the same. The strength of the capital asset pricing model is the logical progression through efficient sets. We keep moving through the bat wing to find the best place to get to. Um, Consider a return of two risky assets. Uh, if we add more risky assets, I'm sorry, the logical progression through efficient sets, adding risky assets to create a portfolio, and then adding risk-free assets to see what happens to that portfolio. And that's when we get the bat wing and the line that attaches to the bat wing, and that's our efficient frontier right there. The arbitrage pricing theory adds factors until the unsystematic risk for the security is uncorrelated to the systematic risk for the security. Um, the unsystematic risk falls as more securities are added. We know that, and somewhere around 100, it seems to peak out. Systematic risk is never going to change. You can't get rid of it. So the arbitrage pricing theory works off of the theory of arbitrage, saying when something is mispriced in a perfect world where everybody has the same information, everybody knows it's mispriced. And this is where I'm going to age myself. It starts to look a little bit like an Archie Bunker episode, where you have a bunch of fat guys trying to get through the door at the same time. The first guy through the door is going to make it, everybody else gets jammed in the door. That's what arbitrage is. The first guy that spots it gets the money. Everybody else watches them trade. That's why we like computers, because computers do it fast for us. So that's the difference in pedagogy. Differences in application. I don't know if it's pedagogy or pedagogy or whatever, but I say pedagogy. So if that's not right, laugh at me if you want. Differences in application. The arbitrage pricing theory, we can throw as many factors as we want in. It becomes complicated, but we can do it. The capital asset pricing model says, I don't want to do that. I'm going to ignore it. Realistically, multi-factors are closer to reality than one factor. So APT is probably more realistic than CAPN. In a multi-factor model, the relationship of risk and return is the expected return is equal to the risk-free rate plus, and then we're going to start breaking it down. Expected return 1 minus the risk-free rate times beta 1. Expected return 2 minus the risk-free rate times beta 2. Expected all the way out. If the first factor is GNP, beta 1 here is the security's GMP beta. ER1 is the expected return on a security whose beta is the first factor is 1. And the beta to all the other factors is 0. Since the market compensates for risk, expected return 1 minus the risk-free rate is normally going to be positive. You're being compensated to take on risk, so it should be an upward sloping line. Each factor is a risk that cannot be diversified. It has a risk that cannot be diversified away. The higher the beta, the higher the risk for the factor. So once we get into betas, you can't diversify them away. You can hedge them, but it becomes problematic. But hedging of betas is where the portfolio managers are at now. And I'm sorry, I'm starting to lose my well, we're getting near the end anyway, so that's good, but I'm starting to lose my voice completely. For an example, consider a study. We have a number of factors. The monthly growth in industrial production is IP. The expected change for inflation is delta EI. Unanticipated inflation is UI. Unexpected change in relationship between security and risk-free bonds is URP. And I just noticed when I was typing it up, beta URP is actually burp, which I'm 12 years old, so it's pretty funny. But whatever. Unexpected change in relationships between long-term and short-term bonds is UBR. Um, and these numbers work for the period 1958 to 1984. Um, the expected return for stocks, ERS, is 0.0041. That was the expected return, plus 0.136 beta industrial production, minus 0.001 beta um, delta inflation, minus 0.006 beta unexpected inflation, plus 0.0072 burp, minus 0.0052 BUBR. When we actually calculated what the betas were, we got beta IP was 1.1, beta EI was 2, beta UI was 3, beta ERP was 1, and beta UBR is 1.6. We replace all the factors with the numbers. So um, ERS is equal to 0.0041, which was the expected return on the market, plus the beta for I'm sorry. Plus the 1.1 was our beta for the impact of BIP, minus 0.1 times 2, which was the beta for EI, et cetera, et cetera. We put them all for. We ended up with 0.0095. That can be the monthly discount rate for the project or the bond or whatever we're looking at. If we wanted an effective annual rate, it'd be 1.0095 to the power 12 minus 1, which is 12%. So the effective annual rate would be 12%. Um, the one thing that always kind of sticks in my craw a little bit, we have a expected return. So the risk-free rate is 0.0041. Oops, where are we here? Here. So the risk-free rate is 0.0041. Then we start to add on the expected returns, and we know there's not going to be an unexpected return. Um, that gives us our monthly return. And then we have a 12%, 12 times, et cetera, et cetera. So we end up with a 12% annual return. Um, take this page and don't memorize it. Make sure you thoroughly understand it. Hint, hint, hint. Please. Um, the last thing we have is empirical models. So we've had all these theoretical models and how we can price stuff. Theoretically, we can, the expected price of a stock, the return we should see on a stock is the expected return plus the unexpected component. The unexpected component is the systematic plus the unsystematic, et cetera, et cetera. That's great theory. There are a number of asset managers that have said, cool, I want to go at it from a different direction. Um, they both, all the models we have now, both the CAPM and APT, um, we're going to look at uh, an adjustment to expected return based on the beta of some systematic factors. They both create excessive returns proportional to whatever those betas are. But um, sorry about that. Employ less theory. So the empirical ones say the theory's fine. But what I want to really look at is I want to look at um, regularities and relationships in the history of the data. Some people call this data mining. Some people call this line fitting. Some people sneer at it. But what it says is, I get it. But if I can actually look at what's happened in history, then maybe I can assign parameters and attributes to the relationships that have been proven over time. Now, we have to assume that history is going to repeat itself, but um, For example, what's the relationship between the expected return and the size of the firm? Is there one? Do larger firms have larger returns? Or is there less economy to scale as you get larger, and maybe we should expect larger returns from smaller companies? And what's the relationship of market to book value and book value and PE? So we can look at how things have traded against each other over time and create relationships going forward off of those. So and sometimes this works better than betas, by the way. Sometimes it doesn't, but sometimes it works better than betas. So the expected return one is the risk-free rate um, plus our factor for price earnings plus our factor for market to book plus our factor for size. So are we going to have an impact on all three of those? Um, as I said, you have to do a lot of back testing. You have to do a lot of regressing. You have to have access to very good computers. But it's possible that you can create a model that's better than the theoretical models, because what you're doing is, and it's not going to work really well for massive portfolios because it's going to blow your computer out. But if you can create smaller portfolios and back test what happens, then it's possible you can create a better model. And there are certainly fund managers that are doing this. And as I said, I've got a friend in Toronto that is basically doing exactly this. Um, there's also style portfolios. Um, a portfolio, and it sort of breaks down that management style in this case. So if we had a portfolio of high price earnings weighted stocks, that's called a growth portfolio. If we had a portfolio of low price earnings stocks, that's a value portfolio. Um, Sometimes we'll take a portfolio and we'll compare it against indexes. In that case, we've been benchmarked against something. How do you perform against this index? That index is now your benchmark index, and you better be familiar with that index. Now, when you pick that index, make sure it's got something to do with the stocks that you're managing. Um, if I was trading only Canadian venture stocks, I probably shouldn't compare myself to the S&P 500. It doesn't make sense. We can also compare ourselves to our peer groups. The last piece we're going to look at was developed by Dartmouth, and it's called the empirical three-factor model. This takes our this takes our arbitrage pricing theory model, and then we try to empirically monkey with it. Specifically, we have a couple of patterns that we have seen repeatedly in the market. Small companies with little market equity have larger stock returns than larger companies. And the theory behind this one actually kind of works out. If you are a small company and have a 10% move, and have a $2 move, that's going to have a greater percent impact on you than if General Motors has a $2 move. So that's the first piece. Value companies, low PE ratios. Value companies, high book equity to market equity, tend to have higher returns than growth companies. So the excess on a portfolio is going to be the expected return of that portfolio minus the risk-free return. So risk-free is what you can get anywhere. What are you giving me above that? That's also equal to, did I skip something here? I feel like I skipped something here. No, I didn't. Okay. Oops. Oh, bother. Oh, bother. Sorry. All right. So the expected return of I minus the risk-free rate, so that's however how much excess return is this stock going to give us, is the beta of I expected minus the risk-free rate plus um no um size times the small minus big plus high minus small minus big. The expected value of both are expected to be positive. Oops. Um, when we run through all of the possible combinations, the estimated loadings, when we create the regression, because the only reason we're doing this is we can create a regression to figure out what everything should be. The intercept of the model uh, are equivalent to the risk-free rate. Is the breakdown of the three plus our unsystematic piece. The model predicts the intercept is going to be at 0. Is that real? Not sure. The size factor, this piece here, is the difference in returns between small book to market value and large book to market value. The value factor, I did skip something here. Size and value. Okay. The value factor is high minus low, um, the difference of that. The expected values are both expected to be positive, and then we come up with our final equation. I do not believe you're going to be tested on the French three-factor model, but know it anyway. And that's all I've got for you, ladies and gentlemen. Thank you very much for listening to me speak at you for the last 12 weeks. I hope you picked something positive out of it. Um, I'm here, I'm around. If you have any questions, reach out to me, please. Um, Otherwise, very good luck with your careers. As I said at the outset, I don't have any significant concerns about anybody's marks at this point. Um, I went through the highs and lows and the ups and downs and the minimum marks. Um, I think the class average at this point is probably around 85%, maybe a little bit higher. I'm not, I could create any exercise or any test or any exam as hard as I want to, but that doesn't do anything. Punishing you guys with a tough exam doesn't do anything. I want to see what you know, and that's what I'm trying to figure out here. So, good luck in the exam. I will put something out this weekend that tells you exactly what to look for. I'm not going to tell you what the questions are, but I'll tell you what to look for. And I will have this video on as soon as I can get it on. Thank you very much. Have a good evening. Good luck with your careers all.
You so